House of Debt is a new book by Atif, Mian, and Amir Sufi. The authors join me here today. Guys, the main argument in this book is that of the various reasons often given for what caused the recession of 2008 and 2009 and what caused the subsequent sluggishness in the recovery, it was the rise of household debt in the years preceding it that led to a big consumption shortfall in 2008 and 2009. So why don't you take us through first, Amir, how we know that that's the leading cause and how we can rule out other competing narratives.
Yeah, so one of the advantages of our book, I think, is that we collect a lot of data, both at the city level, at the zip code level in the United States, and then we even look cross-sectionally across the entire world. So we look at different countries. And so that's the basic, one of the basic tests we do, is we just find this very systematic pattern that cities in the United States, zip codes in the United States that had a larger rise in household debt saw the biggest decline in spending, the biggest rise in unemployment. And even if you look across the countries in the world, for example, if you look at Europe, the countries that had the biggest rise in household debt had the biggest decline. So we think right away, when you just take a casual look at the data, you don't even have to go too far into the data, you just see this very striking pattern. And that striking pattern is kind of where the book begins, with that piece of evidence, and then starts to go through the details of why household debt would matter.
Okay, and why, Atif, can we rule out other possible explanations, things like the credit channel? Why do we know that this is what the leading reason was for what caused the recession as opposed to other ideas?
There could be alternative explanations. For example, maybe the slowdown is because of bank credit not flowing as much in the economy as it used to. What we do in our work is, Amir talked about the cross-sectional variation that we use. We compare areas that saw the largest increase in household debt versus areas that did not see as much rise in household debt. When we do that comparison, we also look at what is happening to credit flows in those two respective areas. And what we show in our work is, take the big banks, for example, Citibank, Bank of America, and so on. What we show is that in the areas that we are talking about, those kind of banks are both present. And so if there was a national decline in credit supply that was creating these problems, we should see those problems equally in both types of areas, both high household debt areas as well as low household debt areas. And what we show is that it's really coming from the demand side, and particularly demand reduction in the high household debt areas, that is creating these issues of lack of demand and the fall in employment in those areas.
Yeah, and I'll just follow up just for a second. I mean, if you look at some of the basic aggregate statistics, they're pretty hard to reconcile with this bank lending view. So for example, the National Federation of Independent Businesses, these are small businesses that survey. They ask businesses what their biggest problem is. All of them in 2008 and 2009, the number one reason by far is poor sales. They say, look, we can't sell anything. It never got above 5% in terms of the number of people of saying that they're having a trouble getting credit. So it just doesn't seem like there was a lot of evidence that what was really going on is firms were desperately trying to get credit, and they had these great projects. Instead, it looks like basically firms are freaking out because no one's buying their goods.
Sure. I want to talk about the price bubble for a minute as well, because you guys talk about how it was actually the rise of credit that led to the price bubble, and then it was higher prices that subsequently led people to take more cash out of their homes. How do we know, take us through the methodological approach. How do we know that it was credit that led to home prices rising rather than the other way around?
Right, so one of the things we do is we first just document that there was this very widespread across the country expansion in mortgage credit to subprime borrowers with low credit scores, what we call marginal borrowers in the book. And that was occurring in every city in the country. So the way we try to show that that's really the causal channel, that expansion in credit was pushing up house prices rather than house prices bringing the credit in, is we focus on cities that are essentially immune to bubbles. Think about like Kansas City, Kansas, where it's very flat. And so it's very hard to actually get bubbles in these areas. And what we show is there was no bubble in Kansas City, and yet you still saw a huge amount of subprime credit going into Kansas City. So we basically make an argument that it couldn't have been that lenders expected high house price growth, which is why they started lending like crazy to subprime borrowers. It's more likely that, like Atif mentioned, something about the global savings glut, money coming into the US through the securitization system, led to credit going into these subprime zip codes, and that kind of happened nationwide.
Okay, and is there room in your thesis for the possibility that there are complementary narratives here rather than like this one exclusive explanation? So one of the issues here is that we're kind of unavoidably dealing with a counterfactual, right? We can't get away from the fact that policymakers, as you note in the book, did an awful lot to stabilize the financial system. They obviously didn't do enough for households, and so we're sort of left with the idea that we don't know how bad things would have gotten if they hadn't stabilized the financial system. We just know how bad things were. So I guess my question is it possible that this is one of several different possible channels that matters, but the other ones do matter? We just never found out how bad they could have gotten.
Yeah, well, I'll talk about three key channels. One is what we talk about, the household demand channel. But the other two are the banking and the fiscal policy side of it. Now, on banking, while we criticize the emphasis on banking, we don't disagree with some of the measures that were taken, especially when it comes to dealing with the whole liquidity issue. So there is no doubt that the Fed had to step in to provide liquidity, especially in the fall of 2008. So I think all of that was needed to be done, and it was required to stabilize the banking sector. It's what we criticize is the lack of emphasis on the household sector and not caring about household debt. That's number one. Number two, there is another complementary policy, which is the fiscal side. And obviously, what we talk about is the weakness in demand that is driven by the underwater homeowners and other things related to high levels of household debt. One complementary action that the government can do is to push on fiscal spending to kind of compensate for the gap in demand or excess capacity that is being created in the economy. So all of these are, in our view, complementary narratives, but it is important to understand the relative value or merit of all of these hypotheses.
Sure, and let's take that and go straight into your preferred solution here, which wasn't just limited to monetary policy being more aggressive, fiscal policy being more aggressive, but that homeowners should have had the principal on their mortgages reduced either through rewriting the bankruptcy code or by the government spending money and taking over that part of what the servicers traditionally do. Tie that into your thesis and why that would have been the best solution to the problem.
Right. So, I mean, I think the central argument we're making is that when house prices crash and it so disproportionately affects debtors, these are the borrowers that are people in the economy that tend to have the highest marginal propensity to consume. And MPCs generally in good times maybe don't matter so much, but in the midst of a crisis, you want to direct funds towards those agents that have the highest marginal propensity to consume. So our idea is that if you really want to do the proper policy to try to boost spending, a better way to put it probably is that you don't want spending to collapse as much as it was collapsing. It is to kind of direct funds toward these underwater homeowners, towards people who have the highest marginal propensity to consume, which is something that comes straight out of our research that we show is pretty definitive. Another policy that we advocate, which is hard to imagine any single economic rationale against, is just allowing solvent homeowners, people who have never defaulted, to refinance into lower rates, right? This is something that was supported across the political spectrum. And like I said, it's very hard to come up with a single economic rationale for not allowing 20, 25 million, maybe even 30 million homeowners in 2009 to refinance into lower interest rate mortgages. We think that would have been an enormously effective fiscal stimulus, and it wouldn't have cost essentially the government anything because it would have just led to lower bond yields, and it would have affected creditors, but it wouldn't have affected the government at all.
Atif, Mian, Amir, Sufi, thanks for being here.
Thank you.
If you were watching this on ft.com, you can get a longer extended version of the interview at ftalphaville.ft.com. Thanks for watching.